Today is March the 15th, 2026, and this is the second part of our deep dive into FUBO, the penny stock spotlight. We have, where we were last time, we ended up pointing out the fact that FUBO actually has positive EBITDA. And we ran this calculation, found out that FUBO does have positive EBITDA. And so from there, what we want to do is I'm going to move on into a discussion of ultimately work up to the valuation of FUBO and what's about to happen with the company and how that affects you and how we got here and all that kind of stuff. First of all, I need to make a statement. I actually carry a designation for business valuation and have appraised many closely held businesses and a lot of tangible assets as well as some intangible personal property. This that I'm about to tell you does not qualify as a business valuation per se. It doesn't comply with the uniform standards of professional appraisal practice. It does not comply with the standards and ethics of the National Association of Certified Evaluators and Analysts or any other professional organization that has a set of standards and ethics. It would qualify more as a back of the napkin valuation done in a booth at the Waffle House. So really that's kind of what it qualifies for. So it just, and as always, none of this is investment advice. Don't go making purchases or sales of assets based on anything I say here. This is just my 2 cents and nothing else. But what I've done is I've used a method called the Guideline Public Company Method. And it's probably about as good as we're going to get. I have not shown all of my work, but and if you'd like to see all of my work, I'll be happy to show it to you, because if you've noticed, my channel here doesn't have any ads on it. Point is a pursuit of the truth, not necessarily the pursuit of an income through the channel itself. So let's get started. First of all, a little bit of instruction and education about the capital stack. The capital stack consists of all of the ways that the company finances its operations. For a very simple example, you could have a company that uses 50% debt. That debt can be publicly traded bonds or not, and 50% equity. That equity could be publicly traded stock shares or not, just closely held stock shares. Either way you look at it, you add the debt and the equity, and you end up with 100% of the invested capital of the company. That's the capital stack. Sometimes you can buy it, sometimes you can't. Just to make it a little bit more complicated, just because I want to, really, the company can also issue preferred equity. Preferred equity is a little bit of an odd hybrid. It acts like debt because it's contractual in nature. It has covenants. It has an indenture. It has a prospectus. It may have a maturity date. It just about always has a call date. It has a lot of the aspects that debt has, but it sits on the common stock side, or the shareholder equity side of the balance sheet. So preferred equity is just a little bit odd. It can get even more complicated than that. Debt comes in a lot of different forms, bonds that you can buy or just hold, whether you can buy them on the public markets or not. They can be callable. They can be puttable. They can have all kinds of different tenors. They can be convertible. In the case of FUBO, some of theirs are convertible, and that kind of complicates matters, and why people do that's kind of beyond the scope of this video. But anyway, so you can have warrants. Those are things you can put in there. Anyway, I go into the preferred equity just for a second. Preferred equity to me is really cool. I love the preferred equity world. If you watched segment 1, I talked about how figuratively stocks can be thought of as a street with really posh restaurants on one end of it, and then kind of leading down all the way to the greasy spoon joints on the far end. And then you've got penny stock millionaires, which is the rain-soaked alley behind the greasy spoon places on the far end down there with the dumpsters and the rubbish and all that kind of stuff. Preferred equity would pretty consistently, with a few exceptions, be kind of a decent meal at a chain place like the Longhorn Steakhouse or Olive Garden or maybe Carrabba's or something like that. So, which for me is a good meal. I'm not particularly proud. And so for me, they're a really good meal. And so I really like preferred equity. Moving on. When we value a company, over here in the cloud out of which valuation work comes, there's some approaches to value. I'm really not going to go into those, but what we're doing is we're appraising the invested capital of a company, 100% of the invested capital, all of the debt and all of the equity together to come up with something called the market value of the invested capital. You subtract the debt from that and the market value of the debt, and that leaves you with the market value of the equity, supposedly, which then is dividable into shares. So if you just have a very simple 100 shares, if your market value of invested capital is $1,000, the debt is 500, you subtract the 500, and then of the remaining $500, you divide the 100 shares into the $500, you get one share being about a $5 value. Let's make that just ever so slightly more complicated. This time, not just because I want to, but because it's actually germane to what we're talking about. If you have shares that control versus shares that don't control, they aren't worth the same thing. Control is worth more than non-control. The process is exactly the same through the valuation work into the valuation of the invested capital minus the debt and into the value of the equity. But let's say you have 50 shares that are voting shares and 50 shares that are non-voting shares, which means that all of the voting goes to these 50 shares. It turns out that you can do that very same math that we did on the previous slide, but the 50 voting shares will actually be worth more than 50% of the equity, and the non-voting shares will actually be worth less than 50% of the equity. How much more and how much less is a matter of much discussion and theory. And there are databases where I can get data points when I'm valuing a business that help me support opinions of a certain amount of control premiums and discounts for lack of control. But the important point is that voting shares are worth more than non-voting shares. How much? Matter of discussion. All right. The management of a company can really do a lot of bad things to your equity. They really can, especially in the trading world where equities and debt are publicly traded. It's a little different with closely held businesses where you have control positions and things like that. But if you have publicly traded shares, in essence, even though you may even have a vote to your shares, the management, really almost without your consent, can do a whole lot of really bad things to your equity. And the problem is the bad things are easy to do. They can be done without just thoughtlessly or just out of laziness. These are things, I have them here, issuing debt, exchanging favorable debt for unfavorable debt, issuing preferred or common shares, just running the company badly, selling assets or giving them away for nothing or next to nothing. It's really easy. All you got to do is play golf a lot and not care a whole lot about the company. Good things can be done too to your equity, but they're a lot harder to do. You have to actually put effort and or money into making good things happen, like paying off debt, calling preferred shares, buying back common shares. All those things take money. Running the company well, or buying or creating assets that are accretive. Doing those things takes a lot of effort. That requires you maybe to spend your Saturdays in the office or out in the field as opposed to on the golf course or watching sports. So it's a matter of you're really at the mercy of the management. And the problem is, in the publicly traded markets, whether you have a vote or not, you really don't have a whole lot of say in the matter. They can, without your consent, pretty much get a lot of stuff done. So how did we get here on FUBO? We talked a little bit about this in the first segment, but this is really where the rubber meets the road. In the reverse merger that took place during the fourth quarter of 2025, there's a lot of information and numbers on this sheet. If you'd like to, you're welcome to pause the video and look at all of this. The important points are these, though. Before the merger, the reverse merger, there was 47% debt and 53% common equity. And there was one class of shares. And that class of shares all had a vote. So you had a share, you had a vote. The way that worked out, if you run the numbers, this tiny little percentage here was actually the amount of influence in the capital stack your one share had. After the reverse merger, what happened in the reverse merger was that these B shares here, 947,910,220, those were given to Disney, and in exchange, Disney wrote a $145 million debt note and began the process of paying back and taking over the debt inside of FUBO. In doing so, what they ended up with was a capital stack that was about 69% debt. And bear in mind that the more debt you have in your capital stack to a certain reasonable point risks up the equity itself. So there's an equity risk that comes with more debt in the capital stack. Think about it. It makes sense. Can you pay that debt back? Are you going to be able to do the thing that you wanted to with the debt and have it be accretive? What's going to happen between now and then? There's just a whole lot that goes into it, but debt is very rigid. It's contractual in nature. You have to pay a certain amount in interest and you have to pay a certain amount back. And then there are other covenants that you might have that you have to abide by while you have the debt. It's very rigid, whereas common equity is not. Common equity, all debts are off. Basically, you get what's left after everybody else, including the debt holders, get paid. So in the transaction, the A shares kind of got shoved aside and the B shares got all of the vote, and we ended up taking on a whole lot more debt. And if you run those numbers, you come up with this tiny little percentage right down here. And if you run the calculation it takes to show basically how much influence change your share had before versus after the reverse merger, essentially your share lost 84.5% of its influence from before to after, but it actually lost more than that because it also lost the right to vote. So we know that it lost more than 84.5%. We don't know how much more, but it lost more. Now, if you take a look at FUBO here, here we are looking at a year of FUBO. Right through here, we do some sort of, right through here, some sort of top. And FUBO for the earlier part of the year kind of cycles between about $2.50 and maybe $4.50, something like that. I guess if you take, $4.50 and you want your shares to go down, what, 85%? Your shares should be somewhere in the neighborhood of 65 to 70 cents per share. Now, they're not down to 65 to 67 cents per share, but they are all the way down to $1.19. What the market does is what the market does. And we don't really know what happens next, but you can totally see. Now, we're just explaining why those shares, one reason why those shares would have done that. So going forward, what's going to happen with FUBO? Here it is. Disney's already put the structure in place. They've already kind of fired the shot and showed you what's going to happen. Disney is essentially, because they control all of the equity here, they have all of the vote. What they're going to do is they're never going to give you a dividend. Now, you probably didn't go into this looking for a dividend in the first place, but they're never going to give you a dividend, so don't expect one, because if they gave a dividend, they'd have to give it to all of the shareholders, and they don't particularly want to give a dividend to all the shareholders if they control the whole thing. What they're going to do is they're going to continually write debt for the company in a related manner. The company's then going to pay them back in interest and pay the debt back, and they're just going to do this over and over and over again. So all of the value going forward is going to come out of the debt tranche of the capital structure. It's not going to come out of the equity structure, and it certainly isn't going to come out of the Class A equity of the structure. We know, let me put it this way, it would be very surprising if the Class B equity, which is 100% of the vote and all owned by Disney, got diluted. They're not going to do that because they control the company. However, we already know that the Class A equity is subject to dilution. We know that because at the end of the fourth quarter of last year, we had exactly the same number of Class B shares that we had in the first week of February with what I like to call the proxy, non-proxy. They put out, statutorily, the SEC required Disney to, or FUBO, to put out a proxy of sorts to tell you that they were going to reverse split the shares, but they already had all of Disney's votes for it. And so it says, I'm paraphrasing, but it essentially says in the proxy, don't send us any votes. We don't need them. We already have them. Well, no, Disney already voted 100% and they were just statutorily required. But it's interesting because there's some information in what I like to refer to as the proxy, non-proxy that we otherwise didn't know. And one of them is that whereas at the end of the fourth quarter of 2025, we had 351,921,000 shares. Whereas by the time we get to the first week of February of 2026, we have 352,715,000 shares. They are going to dilute the common equity right on and on. They're going to use it as a tool. They're going to take it and they're going to give restricted shares to people who go to work there. And then they're going to require them to work for a couple of years. Then they're going to vest. And then those people who are going to be advised by people who probably have a presentation that looks kind of like this are going to go, yeah, I would sell those shares. You don't have any vote, and they're just going to get diluted going forward. We all know that. And so they're selling their shares, and they're like buying Google and Microsoft and Tesla and Palantir and who knows what else. So they're not holding on to their FUBO shares. And if you look at, we did this in the first segment. If you look at SECform4.com, we don't see any purchasing of FUBO shares. That's the reason, is that everybody in the know will know that the Class A shares are just going to get diluted. And this reverse split that they're about to have, expect this over and over again over the next, expect one every 3 to 5 years, just a reverse split, because there's going to be an invisible thumb essentially just on top of the A shares pushing the price down just indefinitely, because that's what they're going to do. So what that means, you buy the Class A shares, you have become Disney's whipping boy. You buy the Class A shares, figuratively, you have decided that you want a girlfriend, but the girlfriend that you got carries a stick in one hand and a leather strap in the other one. And when you so much as look at her sideways, she takes one of them upside your head. And she has a bunch of beer drinking, smoking friends that lay around your house, and you can't ever go to the bathroom because they knock on the door drunk, and you can't ever sleep because they play a lot of loud music, but you have a girlfriend. You're not alone. So that is the figurative nature of owning FUBO's Class A common equity, which is what you're buying in the open market. You can't buy anything else. You can't even buy the debt. I don't think it's publicly traded. Disney has most all of it, and what is it? Mudrick Capital, I believe, is who owns a lot of the rest of it. There's a little bit out there, but it's not publicly traded. All right. This is actually the last slide we have. This is the actual valuation. Again, there are a lot of numbers on this. Feel free to stop it and take a look at them, but I'm just going to step you through a few of them. Right? We know that before the reverse merger, FUBO had this much in annual revenue for the 4 quarters before the reverse merger actually happened. Right? $1,616 million of revenue. And it had negative but improving EBITDA. They hadn't had positive EBITDA. After the reverse merger, you now have Hulu plus Live in there. You have Disney owning it. FUBO had 1 quarter of revenue, and we found out positive EBITDA finally. All right. The analysts that I follow, this is the average for all of the analysts' projections. If you take that number, multiply it by 4, you're, I don't know, a couple $100 million off of this number. So they're actually projecting the revenue to increase, but it's a reasonable number. And we know from the non-proxy proxy or proxy non-proxy that this is how many shares there were as of the first week of February. So we can take that projection of revenue, divide it by that number of shares, and multiply it by a price to revenue multiplier, and we can come up with an expected price. In this particular area, entertainment and streaming, it is really common for companies to have negative EBITDA. It must just be, well, it's entertainment. And, you know, I live at least part of the time in Nashville, Tennessee, and I can tell you, entertainment really, really struggles. A lot of it is hit or miss, very, very low margins and stuff like that. And there are some industries that are that way. They just don't have great margins. I've appraised many closely held businesses in several different, like, for example, collision centers for cars have very tight margins to the point that you really almost can't hire professional management to run a store location for you. Insurance companies, however, like insurance agencies, they have really high margins and they're very, very cash flowing companies. So I'm guessing that this is just a kind of a tough business to be in to start with. Entertainment just is. With how fast they seem to cancel every show I like, eight episodes into the season, it must just be a tough business to be in. So we know that FUBO has 1 quarter of positive EBITDA, a good thing, but we haven't had it before. These are the companies I really found that were similar to FUBO. The problem with Netflix is that it's so big. I mean, you can see FUBO has $1,547 million market cap. You got to be a little bit careful because some of the lists you'll see only take the trading shares. The market capitalization is the number of shares out there multiplied by the current price of the shares. It's real easy for some services to simply take the number of trading shares that there are. And if you only took the Class A shares, FUBO would only have like $430 million worth of market capitalization, but it doesn't. If you take this 1.3 billion of shares, multiply it by the current, $1.17, I think it is, you end up with 1,547,000, and a respectable list like the one I pulled these up off of Schwab will say that. But Netflix is just so huge. FUBO is in the Russell 2000. It's not even in any of the S&P indexes at all. It's not even in the Russell 1000. It's in the Russell 2000, which is the back end of the Russell 3000. It's the smallest companies out there, despite having a market cap like that. So comparing it to Netflix with its positive EBITDA and being in the S&P 500, I can't really do that. That would be akin to comparing a trailer park to a really nice condominium complex. I can't really do that. Angel Studios and Stars Entertainment are not far enough out for their from their IPOs to have had enough to be kind of through their shakeout period, so to speak. Mega Matrix is a foreign company. It's a little hard because they actually report on IFRS, and there's a little bit of a sync up there, and it's kind of tough to get their information just a little bit. So I dropped them, and then Cartoon Studios was so small that I dropped them. If you take those three, Curiosity Stream, Gaia, and Cineverse, the flaw in it, their market capitalization is a lot smaller than FUBO. That's true. Only one of them only has a positive EBITDA. Two of them have single classes of stock, which means that you get a vote, and we don't have a vote. So I'm going to try to work around that here. If you go back to 2022 and 2023, and you just simply take FUBO before, and the reason is because the announcement that Disney was going to do the reverse merger took place in January of 2025. So if you take 2023 and 2024, you get this high and this low of a price to revenue multiple. I was going to say, when you're doing a guideline company method, it's nice if you can have more than one metric to value the company on. Problem is when those metrics go negative, like EBITDA, you really can't do anything with it. And so it's so hit or miss that really the only thing we can value these companies on in this particular area of or sector of the market is really price to revenue. So that's all we have to work on. This is the high, this is the low. If you take that revenue, divide it by that number of shares, and multiply it by either of those two, you get these indicators here. Interestingly, the low is $1.12 per share, and we know that FUBO is currently $1.19 a share. Sorry, I think I said $1.17 a minute ago. $1.19 a share. And so you're like, well, hey, it's as low as it's going to get. Well, by valuation, at least according to its most recent, untainted by the reverse merger history, that there is some truth to that statement. If you take the three comparables that are there and trim it by one on either side, I know that seems a little arbitrary, but it's common practice in valuation. If I do that, I end up with this range right here, 360 to 1250. And you're like, well, that's higher. Yes. If you take Gaia only, which has a negative EBITDA, but has two stock classes, and you do that very same thing for 2025, you get this range. If you take Curiosity Stream, which has a single class, which is different, but has a positive EBITDA, you get these much higher numbers here. Looking at these ranges, a high and a low from each of these different techniques, a single stock comparison, a single stock comparison, averages of 3, high and low, and the company's own history prior to the merger, it looks like the very bottom of the valuation range should be kind of where the stock is right now. Now, that said, we don't know where the stock really goes. The interesting thing is that with the numbers that we had back in December, before the merger, before we even had that or early January, we can see some people were. So here's January, right? There's the end of the year right there. You can see that some people were already kind of back of the napkin figuring out kind of what was going on and were selling out of FUBO stock. Then we get the numbers, and the numbers were actually announced right here. You can see the market just figures it out. Some of the smarter money earlier, and then down it goes. This could have been figured out. It probably was one of the world's easiest short positions to take, because we can see what happened between the before and after, and you can see it coming. And so I don't really totally understand why the likes of BlackRock and Vanguard continued to hold over 20 million shares each. If you at any point in the future are within the sound of my voice and you work for BlackRock or Vanguard or any of the hedge funds or other institutional investors who held FUBO through that period, I would love to hear from you. I'd love to know why you continued to hold those shares and continue to hold them today. At this point, they're kind of down at the bottom of the valuation range. Now, that doesn't mean that they're just going up from here. We happen to know, best way to say this, there are a lot of academic studies out there that have shown, and quite aptly, I'd say, that the value of a publicly traded asset can have as little as 15% to do with its actual trading price, can have as much to do as 40% with its actual trading price. In other words, the value is an anchor. It is not like completely indicative of where its trading price should be. Its trading price will both overbuy and oversell around its value, and quite often can get multiple standard deviations of the mean away from the actual intrinsic value of an asset. And as you can see from what we've been doing here, what is the intrinsic value of an asset? Well, we have all these indicators. It looks like it's somewhere between $1.12 and $27.96, right? And look, that's the way business valuation is. It has these wide ranges, and then as a valuer, I have to call it somewhere. So that's kind of the way that works. Here's my recommendation. We know from the proxy non-proxy that FUBO is about to go through a reverse split. We don't know exactly what's going to happen after that. The most publicized reverse split of 2025, I believe, probably arguably, was Lucid. They did a 1-for-10 reverse split right here in September of last year. From there, their stock actually lurched and went up for a while. If you were a clever trader, you could have made some money off of this. But if you were just a buy and hold investor, or if you weren't that great of a trader, you actually ended up with a stock price that's well below where it even closed the day before the reverse split. So you have to be careful with this. Stocks are down for a reason, and FUBO is down for a reason. Lucid was down for a reason. You may get something that looks like that again. It's going to shake some things up. You're going to have some institutional investors who are going to now, because of their mandates and stock price restrictions, they're going to be able to buy FUBO shares where they weren't able to before. It's debatable how many of those there really are. I don't think they've ever really done a successful study to figure out how many of those there are. There are some. We just don't know how many. So some are actually going to be able to buy FUBO shares, but I think most of the world at this point will have figured out that they really kind of don't want to be Disney's whipping boy. So anyway, yes, it is possible, Creative Ostrich 4066, that you could quadruple or even quintuple your money on FUBO stock. It would be a bumpy ride, and there's going to be a lot of concern and worry to it. But yes, it is possible. I would not go buying that stock right now. I would wait if I was going to do this at all. And here's what intrigues us with FUBO. We've all seen this. Over here, if you look at it, we've got generally about an average trading volume of about 15 million shares a day. It's so liquid, it has weeklies. It's so well optioned that it has leaps. here's a January 2027 and a January 2028 leap. So FUBO is easy to take a position on one way or the other. But the problem is with a looming reverse split and these shares all the way down at the bottom of their valuation range, you just don't know what's going to happen. And I would prefer to, I'd prefer to have a girlfriend who was just a little nicer to me and didn't hang around with people that were going to make my life rough. So that's what I have. I would not buy it right now. I can't tell you that it wouldn't be a good thing after the reverse split, that maybe it would be something you want to look into. So, Matt, thank you again for something to think about. This will wrap up. Until something changes, I probably won't check back into FUBO again. I've got other things to do. My wife actually wants me to do this very same thing for Ross stores. She likes the way their stock looks. It looks real solid from the outside. And so she wants me to do the same thing for Ross stores. And I will. I'll upload a video on that too. But thank you all for watching. If you watched this and found it useful, I really would appreciate it if you'd subscribe to my channel. We don't have a whole lot of subscribers. Matt, I know you're out there, and really appreciate the positive comments you've given us. But I really would appreciate a subscribe if any of you could, because I'll be doing this right on and on. This was a penny stock spotlight. We'll also have weekly deep dives, is what we're going to call them. Weekly deep dives into stocks that are not penny stocks. And then, of course, there's the 10 Mil Club video where we just talk about the portfolio, and I still have to get that out this weekend. So thank you a lot for watching.